Hello and welcome to today's episode, which explains role of banks and specialized financial institutions in foreign trade finance. Let's first understand the important terms and terminology used in banks, specialized financial institution and foreign trade. This will give us a clear understanding of the basic terms used, after which we would go into details. Financial institution. In finance and economics, a financial institution is an institution that provides financial services for its clients or members. Foreign trade. Foreign trade in India includes all imports and exports to and from India. At the level of central government, it is administered by the Ministry of Commerce and Industry. With this, we cover only the basic terms. There is a lot more to learn. But before that, let me give a quick introduction about myself. I am Miss Pallavi Mohan, have worked for 17 plus years, both nationally and internationally. Well-rounded across marketing and operations functions. My previous assignments was with Samsung Electronics as corporate communication professional. Over the years, I have worked in different domains including marketing, sales, business operation, finance, strategic retail, and more. Students, it's really important to learn the terms and topics which go consistent with role of banks and specialized financial institution in foreign trade finance. Allow me to take you through this one by one along with current examples. Bank. A bank is a financial institution that creates credit by lending money to a borrower, thereby creating a corresponding deposit on the bank's balance sheet. Example in News 2016, the famous Vijay Mallya case. News headline, Vijay Mallya debt. FM Arun Jaitley says pays dues or face action. Summary. In a stern warning to willful defaulter like Vijay Mallya, Finance Minister Arun Jaitley said they should settle their dues with the banks or else be ready to face actions by lenders and investigative agencies. A financial institution is an establishment that conducts financial transactions such as investments, loans, and deposits. Almost everyone deals with financial institution on a regular basis. Everything from depositing money to taking out loans and exchanging currencies must be done through financial institutions. Here is an overview of some of the major categories of financial institutions and their roles in the financial system. Commercial banks accept deposits and provide security and convenience to their customers. Part of the original purpose of bank was to offer customers safekeeping for their money. By keeping physical cash at home or in a wallet, there are risks of loss due to theft and accidents, not to mention the loss of possible income from interest. With banks, consumers no longer need to keep large amounts of currency on hand. Transactions can be handled with checks, debit cards, or credit cards instead. Students, I carry a credit card which works only with a PIN password and carry very little cash. This is now becoming more common with all retail places, food joints, airlines, and more using credit card machines. Commercial banks also make loans that individual and businesses use to buy goods or expand business operations, which in turn leads to more deposited funds that make their way to banks. If banks can lend money at a higher interest rate, then they have to pay for funds and operating costs, they make money. Banks also serve often underappreciated roles as payment agents within a country and between nations. Not only do banks issue debit cards that allow account holders to pay for goods, with the swipe of a card, they can also arrange wire transfer with other institutions. Banks essentially underwrite financial transactions by lending their reputation and credibility to the transaction. A check is basically just a promissory note between two people, but without a bank's name and information on that note. No merchant would accept it. As payment agents, banks make commercial transactions much more convenient. It is not necessary to carry around large amounts of physical currency when merchants will accept the checks, debit cards, or credit cards that banks provide. An investment bank is a financial intermediary that performs a variety of services for businesses and some governments. The stock market crash of 1929 and Great Depression causes the United States government to increase financial market regulations. While investment banks may be called banks, their operations are far different than deposit-gathering commercial banks. An investment bank provides a variety of services for businesses and some governments. These services include underwriting debt and equity offering, acting as an intermediary between an issuer of securities and the investing public, making markets, facilitating mergers and other corporate reorganizations, and acting as a broker for institutional clients. They may also provide research and financial advisory services to companies. As a general rule, investment banks focus on initial public offerings, IPOs, and large public and private share offerings. Traditionally, investment banks do not deal with the general public. However, some of the big names in investment banking, such as J.P. Morgan Chase, Bank of America, and Citigroup, also operate commercial banks. Other past and present investment banks you may have heard of include Morgan Stanley, Goldman Sachs, Lehman Brothers, and First Boston. Generally speaking, investment banks are subject to less regulation than commercial banks, while investment banks operate under the supervision of regulatory bodies like the Securities and Exchange Commission, FINRA, and US Treasury. There are typically fewer restrictions when it comes to maintaining capital ratios or introducing new products. Insurance companies pool risk by collecting premiums from a large group of people who want to protect themselves and or their loved ones against a particular loss, such as a fire, car accident, illness, lawsuit, disability, or death. Insurance helps individuals and companies manage risk and preserve wealth. By insuring a large number of people, insurance companies can operate profitably and at the same time pay for claims that may arise. Insurance companies use statistical analysis to project what their actual losses will be within a given class. They know that not all insured individuals will suffer losses at the same time or at all. A brokerage acts as an intermediary between buyer and sellers to facilitate securities transactions. Brokerage companies are compensated via commission after the transaction has been successfully completed. For example, when a trade order for a stock is carried out, an individual often pays a transaction fee for the brokerage company's efforts to execute the trade. A brokerage can be either full service or discount. A full-service brokerage provides investment advice, portfolio management, and trade execution. In exchange for this high level of service, customers pay significant commissions on each trade. Discount brokers allow investors to perform their own investment research and make their own decision. The brokerage still executes investors' trade, but since it doesn't provide the other services of a full-service brokerage, its trade commissions are much smaller. An investment company is a corporation or a trust through which individuals invest in diversified, professionally managed portfolios of securities by pooling their funds with those of other investors. Rather than purchasing combinations of individual stocks and bonds for a portfolio, an investor can purchase securities indirectly through a packaged product like a mutual fund. Specialized financial institutions in India make an important segment amongst all the financial institutions in India. The Indian financial institutions are governed under the regulation of both the state and central governments. The governments, on the other hand, use them in structuring the planning and development of the country. With the help of these financial institutions, the government takes up projects and tasks in order to enhance the overall economic scenario of the country. Depending on the economic importance of the financial organization, all the financial institutions of India can be divided under following categories. Specialized financial institutions in India, All India, Development Bank, State level institution, investment institutions, other institutions. In India, there are specialized financial institutions in all levels. Both in the central and state level, there are a wide variety of financial institutions offering various financial services. The specialized financial institutions in India are not only committed to offer special financial services to its clients, but also devoted to attain certain missions in the steps of economic development of the country. Some of the major financial institutions of India, such as the Industrial Finance Corporation of India, Industrial Development Bank of India, ICICI, and Export-Import Bank of India, are specialized financial institutions in India that work both in the state level and central level. Apart from these top listed financial institutions, there are other financial institutions also that offer specialized financial services to its clients. These financial institutions are generally devoted to serve some specific domain such as small and medium scale industries, housing, agricultural, railways, shipping, power, road and others. Small and medium scale business and agriculture are the two domains for which these specialized financial institutions have come up with various financial products and services. Trade finance signifies financing for trade, and it concerns both domestic and international trade transactions. A trade transaction requires a seller of goods and services as well as a buyer. Various intermediaries such as banks and financial institutions can facilitate these transactions by financing the trade. Specialized financial institutions like Export Credit Guarantee Corporation of India Limited and Export-Import Bank of India, Exim, also offers special financial services to help the exporters with their businesses. Apart from offering financial product, these institutions also provide guarantee products to the export companies. International trade is the exchange of capital goods and services across international borders or territories, which could involve the activities of the government and individual. In most countries, such trade represents a significant share of gross domestic product, GDP. Students, let's understand what is foreign trade, types and importance of foreign trade. Foreign trade is nothing but trade between the different countries of the world. It is also called as international trade, external trade or inter-regional trade. It consists of imports, exports and entry-port. The inflow of goods in a country is called import trade, whereas outflow of goods from a country is called export trade. Many times goods are imported for the purpose of re-export after some processing operation. This is called entry-port trade. Foreign trade basically takes place for mutual satisfaction of wants and utilities of resources. Foreign trade can be divided into following three groups. Import trade. Import trade refers to purchase of goods by one country from another country or inflow of goods and services from foreign country to home country. Export trade. Export trade refers to the sale of goods by one country to another country or outflow of goods from home country to foreign country. Entry-port trade. Entreport trade is also known as re-export. It refers to purchase of goods from one country and then selling them to another country after some processing operations. Following points explain the need and importance of foreign trade in a nation. Division of labor and specialization. Foreign trade leads to division of labor and specialization at the world level. Some countries have abundant natural resources. They should export raw materials and import finished goods from countries which are advanced in skilled manpower. This gives benefits to all the countries and thereby leading to division of labor and specialization. Optimum allocation and utilization of resources. Due to specialization, unproductive lines can be eliminated and wastage of resource avoided. In other words, resources are channelized for the production of only those goods which would give highest return. Thus, there is rational allocation and utilization of resources at the international level due to foreign trade. Third, equality of prices. Prices can be stabilized by foreign trade. It helps to keep the demand and supply position stable, which in turn stabilizes the prices, making allowances for transport and other marketing expenses. 4. Availability of multiple choices. Foreign trade helps in providing a better choice to the consumers. It helps in making available new variety to consumers all over the world. Fifth, ensures quality and standard goods. Foreign trade is highly competitive. To maintain and increase the demand for goods, the exporting countries have to keep up the quality of goods. Thus, quality and standardized goods are produced. 6. Raises standard of living of the people. Imports can facilitate standard of living of the people. This is because people can have a choice of new and better variety of goods and services. By consuming new and better variety of goods, people can improve their standard of living. 7. Generate employment opportunities. Foreign trade help in generating employment opportunities by increasing the mobility of labor and resources. It generates direct employment in import sector and indirect employment in other sector of the economy, such as industry, service sector, insurance, banking, transport, communication, etc. 8th, facilitate economic development. Imports facilitate economic development of a nation. This is because with the import of capital goods and technology, a country can generate growth in all sectors of the economy, that is agriculture, industry and service sector. 9. Assistance during natural calamities. During natural calamities such as earthquakes, floods, famines, etc., the affected countries face the problem of shortage of essential goods. Foreign trade enable a country to import food grains and medicines from other countries to help the affected people. 10. Maintains balance of payment position. Every country has to maintain its balance of payment position. Since every country has to import, which results in outflow of foreign exchange, it also deals in export for the inflow of foreign exchange. 11. Brings reputation and helps earn goodwill. A country which is involved in exports earns goodwill in the international market. For example, Japan has earned a lot of goodwill in foreign markets due to its export of quality electronic goods. Promote world peace. Foreign trade brings countries closer. It facilitates transfer of technology and other assistance from developed countries to developing countries. It brings different countries closer due to economic relations arising out of trade agreements. Thus, foreign trade creates a friendly atmosphere for avoiding wars and conflicts. It promotes world peace as such countries try to maintain friendly relations among themselves. International trade has flourished over the years due to the many benefits it has offered to different countries across the globe. International trade is the exchange of service, goods and capital among various countries and regions without much hindrance. The international trade accounts for a good part of country's gross domestic product. It is also one of important sources of revenue for a developing country. With the help of modern production techniques, highly advanced transportation systems, transnational cooperation, outsourcing of manufacturing and services, and rapid industrialization, the international trade system is growing and spreading very fast. International trade among different countries is not a new concept. History suggests that in past there were several instances of international trade. Traders used to transport silk and spices through the Silk Route in the 14th and 15th century. The economic, political and social significance of international trade has been theorized in the industrial age. The rise in the international trade is essential for the growth of globalization. The restriction to the international trade would limit the nations to the service and goods produced within its territories, and they would lose out on the valuable revenue from the global trade. The benefit of international trade have been the major drivers of growth for the last half of the 20th century. Nations with strong international trades have become prosperous and have the power to control the world economy. The global trade can become one of the major contributors to the reduction of poverty. David Ricardo, a classical economist, in his principle of comparative advantage, explained how trade can benefit all parties such as individual companies and countries involved in it, as long as goods are produced with different relative cost. The net benefits from such activity are called gain from trade. This is one of the most important concepts in international trade. Adam Smith, another classical economist, with the use of principle of absolute advantage, demonstrated that a country could benefit from trade if it has least absolute cost of production of goods, that is, per unit input yield, a higher volume of output. According to the principle of comparative advantage, benefit of trades are dependent on the opportunity cost of production. The opportunity cost of production of goods is the amount of production of one good reduced to increase production of another good by 1 unit. A country with no absolute advantage in any product, that is, the country is not the most competent producer for any goods, can still be benefited from focusing on exports of goods for which it has the least opportunity cost of production. Benefits of international trade can be reaped further if there is a considerable decrease in barriers to the trade in agriculture and manufacturing goods. Export-Import Bank of India, Exim Banks. Exim Banks is specialized financial institution wholly owned by Government of India, set up in 1982 for financing, facilitating and promoting foreign trade of India. Including the share capital of 1,300 crore received during the year from Government of India, the paid up capital as on March 31, 2015 stood at 5,059 crores and the net worth stood at 9,902 crores. Profit after tax of the bank for the year 2014-15 amounted to 726 crores. Exim Bank extended line of credit LOCs to overseas financial institutions, regional development banks, sovereign government and other entities overseas to enable buyers in those countries to import developmental and infrastructure projects, equipments, goods and services from India on deferred credit terms. Exim Bank has laid strong emphasis on enhancing project export, the funding options for which have been enhanced with introduction of the Buyer's Credit National Export Insurance Account BCNEIA program. The bank facilitates two-way technology transfer by financing import of technology into India and investment abroad by Indian companies for setting up joint ventures, subsidiaries or undertaking overseas acquisitions. To promote high-tech exports from India, the bank has a lending program to finance research and development (R&D) activities of export-oriented companies. During the year ended 31st March 2015, Exim Bank sanctioned loan of 57,684 crores, while disbursements amounted to 38,508 crores. Loan assets stood at 86,953 crores as on March 31st, 2015. During the year, bank issued India's first USD-denominated green bonds with a benchmark size of $500 million. During the year, an Export Development Fund (EDF) facility, a special fund established by Government of India under the Exim Bank Act and administered by Exim Bank to sanction loans in the interest of international trade towards meeting strategic objectives was put to use. Exim Banks under the Government of India Act East Initiative undertook a mission of CLMV countries, consequent to which a project development company is being set up, to be followed by a project development and facilitation framework. Exim Banks IL and FS African Development Bank Group AFDB and SBI jointly floated a project development company in Africa based in Mauritius. The bank has entered in a cooperation agreement on innovation with the 4 major development banks of the BRICS countries, which is expected to promote intra-BRICS cooperation in innovation financing. The bank, with its diverse programs, caters to different segments of exporters and the export cycle. The bank provides assistance in helping Indian firms in their globalization efforts by locating overseas distributors, buyers, partners for their products and services. Exim Bank also lays special emphasis on enhancing export capabilities and international competitiveness of Indian companies through its various advisory services. Students, before we close, we should also know the name of a very important person connected with finances and discuss related important news. Shri Arun Jaitley, Minister of Finance of India. Arun Jaitley is an Indian politician and lawyer who is current Finance Minister, Minister of Corporate Affairs and Minister of Information and Broadcasting in the Cabinet of India. Let's discuss some important news related with Shri Arun Jaitley. Headline: Arun Jaitley said that now is the time when Make in India campaign can translate into actual activities. Finance Minister Arun Jaitley on Wednesday, 30th March 2016, launched Make in India conference in Sydney and asked Australian businesses to be a part of India's growth story. With this, we cover role of banks and specialized financial institutions in foreign trade. That is all for today. Hope you had understood about role of banks and specialized financial institutions in foreign trade finance. We'll see you again with the next topic. Till then, take care. Bye.